The purpose of this problem is to compute variances and then prepare an income statement that presents those variances. The first variance that we'll present for this company is the total materials variance. The total materials variance is the actual quantity times the actual price minus the standard quantity times the standard price. So in this case, we can see that the actual quantity is 11,300 units, and that the actual price in this case is $2.20. So that would give us 24,860. Then we'll subtract the standard quantity times the standard price. And so the standard quantity in this case was 10,900, and the standard price was $2.10, and so that would be 22,890, and so we have a variance of 1,970, and that's an unfavorable variance. The next variance we'll compute is the materials price variance. The materials price variance is the actual quantity times the actual price minus the actual quantity times the standard price. So the actual quantity again is 11,300. The actual price is $2.20, and then actual quantity of 11,300 times the standard price of $2.10 gives us 24,860 minus 23,730. So that gives us a variance of 1,130, and that is unfavorable. The next variance that we're going to compute is the materials quantity variance. The materials quantity variance is the actual quantity times the standard price minus the standard quantity times the standard price. So we have actual quantity of 11,300 times the standard price of $2.10 minus the standard quantity of 10,900 units times the standard price of $2.10. So we have 23,730 minus 22,890 is a variance of $840, and that is unfavorable. The next variance that we do is the total labor variance. The total labor variance is the actual number of hours of labor times the actual rate minus the standard number of hours times the standard rate. So in this case, the actual number of hours worked we can see is 15,000, and the actual rate we need to calculate, and we calculate by dividing the payroll of 166,500 divided by the labor hours worked of 15,000 gives us a rate of $11.10. And then we subtract from that the standard hours, which is 15,200, times the standard rate, and we need to compute the standard rate. That was 159,600, which would be the standard amount of the payroll, divided by the 15,200 gives us a standard rate of $10.50. And so we've got 166,500 minus 159,600 is a variance of 6,900, which is unfavorable. Next, we do the labor price variance. The labor price variance is the actual hours times the actual rate minus the actual hours times the standard rate. So the actual hours we said was 15,000 times the actual rate is $11.10 minus the actual hours of 15,000 times the standard rate, which we computed previously as $10.50. So I have 166,500 minus 157,500 is a variance of 9,000, and that is unfavorable. Next, we do the labor quantity variance. The labor quantity variance takes the actual hours times the standard rate minus the standard hours times the standard rate. So we have 15,000 times $10.50 minus 15,200 times $10.50. So that is 157,500 minus 159,600 gives us 2,100, and that is a favorable variance. Next, we compute the total overhead variance. The total overhead variance is the actual overhead minus the overhead applied. So the actual overhead in this case we can see is 210,000 for 20 minus the overhead applied, which is 214,320, which we can see right here. So we get a variance of 3,900, and that is favorable. The next part of this problem requires that we prepare an income statement for management. We start the statement with the period covered, with the heading, which includes the period covered, which in this case is the month ended June 30th, 2017. Then we show the sales revenue, which we can see above is 473,000. Next, we need to determine the cost of goods sold at standard. To determine the cost of goods sold at standard, we'll take the standard cost of the materials, which is the standard rate times the standard amount of materials, and if we multiply that, we get 22,890. Next, we take the standard amount of labor, which we can see is 159,600, and then we have the manufacturing overhead applied, which is 214,320. So the sum of that would be 396,810. Now that we've got cost of goods sold, we can determine our gross profit at standard. And our gross profit at standard, in this case, is 76,190. Now we'll enter our variances. So our materials price variance, which we can see above, is 1,130, and that is unfavorable. Then we have the materials quantity variance, 840, also unfavorable. Then the labor price variance, 9,000, unfavorable. Then the labor quantity variance, 2,100, and that is favorable. Then finally our overhead variance, which we determined to be 3,900, favorable. So our total variance is, in this case, an unfavorable amount of 4,970. Now we can adjust to arrive at our gross profit actual, which is 71,220. Then we'll subtract out our selling and administrative expenses, which we can see above is 44,400. And so finally we arrive at our net income, and our net income is 26,820.